Everybody. Welcome to our podcast series that SII is going to be doing this year on sustainable investing as we go in and do special reports in the publication on various sectors. We will be doing podcasts along the way with them. And I'm absolutely delighted to say this is the first time we've done one exclusively with an Australian panel. As you all know, around the world, Australia is one of the most advanced markets in sustainability. So it's really nice to get a panel of people in the area of sustainability from Australia to talk about what's happening in natural capital. I'm delighted to be joined today by Cullen Gunn, who is the CEO of Kilter Rural, who's based in Melbourne. We have also with us Sarah Clausen, who is Executive Director, Investor Relations at New Forest in Sydney. I believe, Sarah, that's where you are.
Yes.
And also we have Alex Wise, who's Global Advisory Board Member of Castle Hall, also based in Sydney. So welcome to you all. Thank you very much for agreeing to do this. So I'm going to start this by asking the panel just to give a very brief introduction so you can get an understanding of where they come from on this particular subject. So we come to you first, Sarah.
Sure. Thank you so much, Simon. So I lead investor relations at New Forest, and my role really sits at the intersection of the investors, the markets, and long-term real assets. I spend a lot of my time talking with institutional investors about how nature fits into long-term portfolios. So New Forest is one of the top 5 natural capital investment managers. We have $8 billion terms in assets under management, about 4 million hectares that we manage, making us one of the largest land managers globally.
Thank you very much. And Cullen, can I come to you?
Thanks, Simon. Yeah, I'm a founder of Kilter. We began this in 2004 with a $200 million commitment to invest in natural capital, an SMA, with the local institutions. And the idea was to transform rural landscapes to deliver, sustainable, climate-prepared production systems with, big emphasis on biodiversity conservation and water management. So in these landscapes, water is the key limiting factor, hence investment in water entitlements made a lot of sense to us. We now manage around 600 million worth of assets. That includes 2 open water funds. The premier fund's around 340 mil and has delivered returns of 13% since 2017. The other fund, probably of more relevance here, is the Balanced Water Fund, and that delivers multiple objectives. So returns to investors, water for agriculture, and water for environmental outcomes. You probably consider it, or it is generally classed as an impact fund. Again, that's done very well. It's done 9.6% since inception and delivered around, these numbers don't mean much to people, but 240 billion litres worth of water. It's about filling up the Colosseum 90 times. So, they're not insignificant volumes in a sort of dry environment. And Australia's the driest inhabited continent on Earth.
It's the driest continent on Earth. That's I've learned something this evening already. Yeah, I imagine the big hinterland you have, that would make sense. Yeah.
Yeah, it's mostly desert.
That's a good point.
Yeah.
So Alex, I've known for a few years, and we often meet up when he comes through London. So over to you.
Yeah, lovely to see you, Simon, and thanks for the invite to the podcast. So I work with Castle Hall. Castle Hall is a global due diligence and advisory consulting firm based in Montreal, Canada. I look after the business here in Australia. We work with about 250 allocators globally in terms of conducting due diligence on managers, assisting with various forms of manager selection, including sustainability due diligence, which I helped establish a few years and have led the client efforts with here in Australia and New Zealand.
Excellent. Thank you very much. Right. Well, let's get into it. The first question I'd like to ask you is, what is the prime motivation for LPs to allocate to natural capital. And there is the debate that we're coming across probably increasingly often at the moment, that is it for traditional risk return reasons, or is it first and foremost for climate mitigation reasons? And I'd be very interested to know in what combination you think that might be. So maybe Sarah, I can come to you first.
Sure, thanks, Simon. So, from our perspective, having worked with institutional investors across regions, across cycles, the most important shift we've seen is that natural capital is no longer framed as a trade-off between returns and impact. For most LPs today, it's really understood as sitting squarely at that intersection of financial resilience and real-world relevance. And what's also shifted is how LPs think about risk. So increasingly, nature's viewed as an economic infrastructure. We see many investors explicitly connecting natural capital to physical climate risk mitigation, recognizing assets that are grounded in really productive land, ecosystems. They can help moderate climate-driven volatility rather than amplify it. And the motivations vary by types of LPs, by their size, by their region. So I'd say, for example, large pension funds and sovereign investors, they often lead with risk-adjusted returns diversification. Insurers often focus on resilience, physical risk. Endowments or mission-aligned investors really place a greater weight on biodiversity, climate outcomes. But across all of those groups, the conversations become much more integrated. So the financial outcomes, the environmental outcomes, they're reinforcing each other rather than competing with each other.
Okay. And can I ask you the same question, Cullen?
Yeah, I couldn't argue with any of that from Sarah. It's, I think, very accurate. It does depend a bit where the LP's based, I think. So there are some differences. Some are much more advanced than others. There's no two ways about it. I think the other thing about sort of natural capital assets is they are, as Sarah said, that diversify. You know, you generally can get, well, certainly you look at something like water, you've got stuff that's completely uncorrelated to anything else that's going on. You know, you can get exposure to food production without taking on any of the risk of growing it or any of the risk of commodity pricing. You're just providing that key limiting input. So there's that, you know, that does appeal to people increasingly, I think, that uncorrelated nature, particularly given what's going on with markets around the world at the moment. And they're jumping around a bit. So that has been increasingly a key driver. And I think also then, I mean, going back to 2004, we were driven primarily by returns, but that sort of climate hedge, climate responsibility, climate action, and you know, within that framework, biodiversity protection has always been a key driver for those LPs that are interested in it. I think that the sort of European views significantly advanced to the Australian view, and probably North America as well. It's just North America sort of doesn't really know where Australia is, but the Canadians do. The Canadians are right across it. So, you know, they've been driving it for a long time. You know, I think they've been the biggest investors in Australia over the last 5 or 10 years. Sarah, would that be right? They've been big anyway into natural
Yeah,
capital.
the Maple Leaf definitely are looking at Australia as a really attractive investment opportunity. As an Australian citizen and an American citizen, yes, there are many things that are happening in the US that are complicated, but many of us do know where Australia is located. But I get your point. There are some.
Sorry.
No, it's all good, Cullen. There are some changes in the investment lens in the United States that make ESG and impact difficult. But what I'm finding is climate is still very relevant. You can talk about nature and climate, and that resonates still, even with the North American investors or the American investors.
Well, I'm here to stir the pot and be a bit controversial every now and again. So, Sarah, I'm going to quote something that we did. This is my second go at doing some sort of event today, or the earlier one was a live webcast, and it was on climate risk. And the point that people were making was, and I partly live in the States, so and my wife's American and all that good stuff. So they don't. This is US pension funds, and this is actually backing up what Cullen was saying. They're not nearly as sophisticated as the Canadians, or indeed the Australians, or indeed certainly the North Europeans are. and all of that. Maybe Alex, in a minute, I'm going to ask you to chip in on that because he, as he said, he works with an organization that's Montreal, Canada based, and started with lots of institutional investors from Canada. But that's typically what people, or that was said this afternoon in our time about the US. So that may or may not be true, but I think that's then generally the view out there. So, but
I
you,
agree.
okay, yeah.
No, I do. I agree with that. Yeah. Sorry, go ahead.
No, I was going to see whether you wanted to come back on me on that or not.
The North American pension funds, I think, have had a history of being somewhat conservative. I don't know if it's lack of sophistication. I think some of them investing in what was called timber and not natural capital in the past, in the 80s, where the asset class really took off. Some of them didn't do so well and therefore have put this a little bit on a back burner. And I find other investors are coming to this, whether that's endowments or foundations, or even some of the insurance companies are looking at it more than the typical local pension fund. So
Yeah.
yes, I would agree with the statement.
But
Yeah.
that's just one category, and the pension funds and the family offices are, and particularly with the younger generations taking over, that's probably different. So
Yeah.
Alex, so please come in here
Yeah.
and what's your perspective on this? Because obviously you're based in Sydney, but as you said, Castle Hall's a global organization. And you've had as it's still called, although it's not used as often, the term ESG, but you've got an ESG newsletter that you've been doing now for a good long time, haven't you?
Yes, we
Castle
branded
Hall.
that when ESG was in vogue. So, we've stuck to our guns on that. Environmental, social, and governance are all important things to consider when doing due diligence on fund managers and investment types. But to go back to your question, Simon, in terms of the motivations of LPs, we do work with the complete range of LPs, from the impact driven endowment through to the largest sovereign wealth funds. And the approach, I think, is very segregated within those areas, and from insurance companies which have specific drivers and motivations in terms of why they would like to allocate more to natural capital related investments, through to superannuation funds that are trying to deliver returns for their members, and as well drive some of those values that are aligned with their membership base. And that's certainly something Australian superannuation funds try to do. So the motivations are diverse, but I think generally, real sophistication on natural capital investing is quite nascent. And we see that not only here globally. We do work with a lot of those Canadian pension funds in terms of their approach, and we've done due diligence on everything from forests to pineapple plantations to various forms of agriculture. And there has been some investors, I think, that are much more willing and comfortable, as they get more comfortable with the other aspects of investing, the risk return profiles, diversification elements that natural capital can bring to portfolios, and potential hedging outcomes as well.
Can I again say something potentially slightly controversial? That there is a view, and Chris Addy, who's the CEO of Castle Hall, has actually expressed something along those lines. And some of the investing that the big public pension funds do in this area, in the natural capital area, is to make them look good. It's a good PR thing to show to their beneficiaries that they're doing it. This is not a very scientific point to make, but do you sense there isn't? We want to be seen as altruistic institutions. Is there an element of that too, or not? Or
There always is, and I think that there are huge, public relations benefits that can be gained from doing things that are seen to be, good in an overall sense. Well, one of the things that's happened here in Australia as well is that there has been a focus on investors, particularly superannuation funds and fund managers, that have been really overstating their kind of green credentials, and that's culminated with ASIC, the regulator here, taking action for greenwashing For example, Mercer's superannuation fund was fined $11 million for findings against them. So, that has had an effect on investors where they've actually kind of stepped back from some of their statements. The kind of phrase green hushing has emerged of people not really wanting to kind of talk about their environmental credentials because they're scared of being accused of overstating them. And that's created a reverse cycle where we've actually seen people stepping back from talking about some of these interesting and exciting investments that they're making across natural capital and other impactful asset classes.
Yeah. Just before we leave this area and move into another one, I'd just like to just explore this and maybe come to you, Cullen. When you set up your firm back in, you said 2004, I think, those years, was there an element, I don't know where you were before that you wanted to do something with an altruistic element for water irrigation reasons? Or was it purely you saw a real opportunity in the investment market to do this? What were the motivations?
Well, both those things. Altruism, yeah, look, you want to do the right thing, don't you? You want to make money doing the right thing. That's the best way to get out of bed in the morning. The perfect scenario here is you do the right thing, and the extra bits you're doing right add to the bottom line. That's where we want to get to. That you're protecting the environment, or you're improving water quality, and simultaneously that's improving your return. Now, that's not always easy to do. But certainly our initial investor was looking for that outcome. But with these assets, one of the big challenges, I think, is time frames. So, if you're looking at Australia and you're looking at 230 years of what you might describe as degradation, certainly landscape change for different production outcomes, turning that round in a 5-year period, of a CIO's employment time frame, and showing condition change that really makes a difference. That's a interdecadal process. Just like growing forestry can be. So, I think New Forest have been brilliant at capturing much of this market and delivering, obviously, but it's not easy to do, and the LPs need the right mindset about how to look at these assets. Almost inter-year variabilities, it's not irrelevant, but because there's operational and management expertise going into it. But if that's what you're hanging your hat on, you're going to come unstuck. You've really got to have a long-term view.
And that's well said. Very last question in this area, but did you realize how long it might be? 2004 to 2026?
Look, I guess we've had lots of successes and massive failures, both sides of the coin, and you learn a lot. I guess what's really surprised me, somewhat naively, I think, looking back, is just how important people are and relationships. That's how it all works. So you can have a commitment from an organisation, but if the top echelon of that organisation changes every 3 years, that's a real battle, because the new people coming in, it's not their idea. They're not wedded to it. That's at a local level. I think Alex could probably comment on this, but if you look at the Canadian pension funds, they're set up, they've got a mandate to deploy whatever it is, 2 or 3% of everything that comes in each year to natural capital, some of them. They've got a team that's dedicated to deliver against that. I don't think there's one super fund here in Australia that's doing that. For instance, they might be doing it now with infrastructure, but certainly not at a natural capital level.
Yeah, I agree. And I just want to congratulate you, Cullen, on your overnight success of 24 years of work. But it's such a long slog for managers to really establish themselves. And you guys, New Forests, Kilter, and some of the other Regal boutiques have really kind of stuck to your guns in terms of what you do and how you do things. And that's always what comes out, or should really come out, for LPs when they're conducting their due diligence on fund managers.
All right.
Thanks, Alex.
Right, moving on, Alex, I'd like to come to you and ask you, what are the main obstacles that need to be overcome to see natural capital continue its recent growth well into the future. We see, and we've been in our reports we did a two-part special report on this. There were three particular areas that came up again and again. A few others came up too, but these were the ones that came up most often. So the lack of historical data was very important. And you've half touched upon it in your last answer, Cullen, liquidity risk. You know, if, there were such good long time frames here, and concentration risk, because when an opportunity comes along, everyone and their mother seems to want to pile into it, and one wonders about the valuations of those. So, are those the main obstacles? Please tell me. I'm sure there are other ones too. Be interested in all your views on this. But Alex, do you want to kick off?
Yes, certainly. I think that there are numerous obstacles. But if we're looking close to home here in Australia, superannuation funds have something called the best financial interest duty, whereby that they are obligated by law to have financial interest at the first and foremost hurdle of their investment selection process. That often makes it a little more complicated for managers that are slightly outside of typical asset classes, and that applies equally as much as it does to some alternative investments as it might do to natural capital. So it's almost for managers in this space, I think there are two levels of hurdles. Not only do resort boutique managers have to meet the institutional due diligence, operational due diligence hurdles that are there, but they also have to make this additional hurdle of from a sustainability perspective, demonstrating that they almost have to take some of the investors, and you guys would be familiar with this, on the journey with them. It's a school process. You have to understand the specifics about this asset class, and look, and there are investors that are willing to go on those journeys, and there are others for different reasons who aren't. I think that there are there's some more complexities. Sarah touched on historic experiences some investors have with prior generations of timber and forestry investments, and that's certainly been the case here in Australia, where there were some egregious fees that were charged. There were outrageous commission structures that were in place with financial planners, and this is going back to the 2000s, but these things are still in people's memory. And then on an asset basis, there's been some strange goings on in the kind of forestry sector in New South Wales, with the Environmental Protection Agency actually suing the Forestry Commission effectively here in New South Wales. So there's a lot of weird stuff. So managers have to kind of get themselves above that, be able to really demonstrate that they have this real bona fides in terms of what they do on the allocation side, through their process, through their natural capital, but also on the institutional due diligence side, where you still have to make those hurdles and pass muster when it comes to governance, risk, compliance, operational resilience, etc.
And but before coming to Sarah, you just touched, you said the word governance, but we see sometimes, I don't know whether it's the same where you are, Alex, some of the governance at some of the, at least I don't know about Australia at all, but some of the smaller, more recently launched boutiques in this area, let's just say the governance standards aren't what you'd expect at a more established investment house. I don't know whether that's the same thing where you are at all.
I think it's it's not an uncommon theme globally, Simon. I think, oftentimes boutiques, will be launched, and whatever their strategy is, that's their sort of primary area of focus is myopic focus on investment and returns, and delivering those early 2-3 year track records, and oftentimes governance is an afterthought, and unfortunately that's not really the best place to start, because from ourselves, Castle Hall, when we're conducting due diligence, other consultants, direct teams at supers and pensions, that, really looking primarily for strong governance to be in place across that organization to really raise their comfort levels.
Yeah, fair enough. So, Sarah, can I put the same question to you? What do you think are the main obstacles from sitting at New Forest? You're a well-established manager now with a really good AUM, etc. So, probably some of the boutique issues that some of the managers have in this space probably don't apply so much to you, but nonetheless, I'd be interested here whether you come across the same historical data questions, liquidity questions, concentration risk questions, etc. And what other ones do you come across?
Yeah, thanks very much, Simon. And we have been in business for 20 years. So we started out as a small specialist manager and are now quite global, investing worldwide. So some of those issues Alex mentioned were at the heart of how we started. And I think the benefit of natural capital is the asset class, like Cullen's business and New Forest, was created by specialist managers. That's where the technical expertise, the ecological expertise come from. And now we've built out from there. To your point around barriers, yes, I agree. Data, liquidity, concentration risk. I think familiarity, which is also what Alex mentioned around the asset class. And with time comes growth and expertise and people getting more comfortable with the asset class. Just touching on data, the irony is that natural capital assets have very long operating histories. Forestry, agriculture, these are not new asset classes. And the challenge is that historical and standardized data, so around biodiversity outcomes as well as newer revenue streams, but also just historical data on forestry, on agriculture, benchmarking data that hasn't always been captured and not in a way that aligns with neatly what the institutional frameworks are looking for. So we see progress there, but we know that LPs want greater consistency, comparability. On the concentration risk, and maybe Cullen can pick this up as well, if you look at the sector, you're only looking at forestry, for example, you might conclude that natural capital, it's niche or capacity constrained. Plantation forestry in Australia, for example, proven institutional grade, but it's also relatively small, supply constrained. We have about 1.7 million hectares of plantation land. So forestry does have a natural ceiling, but that's not the full picture of natural capital. When you broaden that lens and you look at agriculture, the concentration risk argument falls away. Agriculture represents more than half of Australia's land mass. So we're talking about hundreds and millions of hectares, a multi-trillion-dollar underlying asset base. And that's an order of magnitude that's much larger than forestry in terms of land value, long-term opportunities. The reason it hasn't absorbed as much institutional capital yet is not because the opportunity isn't there, but the agriculture sector has historically been quite fragmented, under-institutionalized, operationally complex, but that's exactly what's changing now. And so from the investor perspective, perhaps forestry gives a high quality sort of entry-level opportunity into natural capital, but I think agriculture is really where the long-term growth will come from.
Well, yeah, you're absolutely right to say, because I've never really truly understood why forestry, which has had a really good steady return over a long, long period of time, has just not been such a popular asset class, even in this area for so long. When you look at the allocations that have gone into it for decades, as you say, there's nothing new about it at all. It's becoming sexier now because of the sustainability boom, but it's been there for a long time, as you say. Why over the decades would you say it was relatively unattractive to so many long-term investors like pension funds, sovereign wealth funds, and whatever else?
There's some issues Alex touched on around integrity, governance, how things are being managed. That was certainly the case in Australia with the managed investment schemes that fell over like a house of cards when the global financial crisis hit. And actually, New Forest benefited in being able to acquire many assets that went into receivership that were very high quality assets. Not all of those assets were high quality assets. And so Australian superannuation funds in 2010 were sort of looking at this as a dodgy asset class almost, but now we're doing 13, 14% returns in their backyard, and many are scrambling to get back into what is now seen as a natural capital asset class. Australia also has the benefit of forestry and agriculture side by side. Many of our funds have an allocation to both, and that's not necessarily always the case in the US or Europe or Southeast Asia or Africa, where we also are operating. but that provides an advantage to investors who are now coming back to the asset class and looking at it quite differently.
Thanks. And Cullen, you said you've had some successes, but some situations which weren't so successful over the years.
Well,
How
yes,
much of it
there's always a bit
to
of that.
do with things like historical data or lack of historical data,
Oh, look, I'd
liquidity,
agree very
or
much with what the other two have said, Simon. The thing I'd add, just on the concentration thing, certainly locally, one of the challenges is, perceived challenge anyway, is scale, transaction scale. So if you're a growing pension fund and, they're amalgamating and all getting bigger and all that, really turning into Canadian size things, you're looking at transactions that have to be, I don't know, Sarah, let's say 150 to 500 million before they'll get out of bed to look at it.
Yep.
If you look at what we're doing, and even if I produce them a 30% return and it's a one-off investment for them, it just doesn't change the dial for them. So, it's almost their risk is just downside. If it doesn't work, they're pulled out because of the regulatory regime for doing something different. So there is that challenge. Scale and repeatability are big issues, I reckon. Scaled transactions. They want to keep deploying. They find an asset class like infrastructure. People are keeping building infrastructure. There's stuff there for them to keep pouring money into. So I think that's a challenge. It's not insurmountable, as Sarah points out. You put the team to work like the Canadians do, you can find assets. Absolutely, you can find assets. So I think that will change over time. The other key thing that I've sort of over the last half a decade have really discovered, it's come up a number of times, is just how do you measure change? So if you are investing in natural capital to produce a benefit that you are going to publicise, or even better, monetize over time, you need a robust, scientifically robust, independent, auditable trail of condition change. And that it's the holy grail. There's a number of them around, but getting anyone to agree on which one to apply so that it is, as Sarah said before, comparable is a real challenge. And, we were using a thing called Accounting for Nature. I'll disclose I was on the board of Accounting for Nature for an extended period. It's a non-profit organisation, but we were competing with stuff across the world. It's by far the most rigorous and robust reporting framework for environmental accounts there is. We produced environmental accounts of our assets for many years, but by that token, it's costly, and we were not getting the benefit of a market entry point to sell those credits or benefits into. So, you're sort of doing it in the hope that happens, but it hasn't happened. So investors look at that and go, well, I don't know, that's a lot of work for a small scale investment that might not move the dial, that is quite complex. I mean, I've only just understood what the word biodiversity means, So that can be a challenge. I think there absolutely is a movement that's, on the back of TNFD to understand those issues, complexities much better and the impacts. But there's no doubt that was, when we presented to 40 or 50 EU sort of investment houses a couple of years ago, that was the main focus of all of them, really, one way or another. They're committed. They were speaking to us because they're committed to invest in natural capital, but it's all right. Well, how are you measuring the condition change? How is that happening?
I may
so
have
it's another thing to get your head around.
I may have this completely wrong, but I think I wrote something on this about a year ago or more. Something like this 2,000 different forms of measurement you can do from.
Probably more. Yeah, probably more. Yeah. It's a real challenge. It's one of the complexities of it all is getting something, as Sarah and Alex have said, that generates data that's comparable over time. Is that one doing better than this one? It is a challenging space and issue to resolve.
Cullen, you've already with what you've just said answered the next question, but I'll throw it at you anyway to see if there's anything else you want to add to it, because you've been doing this, as you say, for a while now. You're a relatively speaking small specialist manager. You talked about big institutions having difficulty getting them to allocate to you because it might not move the dial and the due diligence they got to do on you, etc. Is there a way of overcoming that? Because some of the most interesting people we meet in what I do I mean, I dramatically prefer to talk to a specialist manager that really knows, as we say in England, his onions or her onions, really knows their business inside out, than going to a BlackRock or an M&G or a Fidelity. It's just, why would you want to go down that route? So is there something that can be done for the larger LPs, or are you going to be playing in the specialist family office space and some of the other high net worth type individuals who maybe take a different view from the big institutions?
Yeah, very good question, Simon. Many of those names you mentioned, we've spoken to, and for an extended period, like up to 5 years, without getting a decision. So it can be quite challenging. Having said that, it's moved a lot. So we've had really good sovereign wealth support and Asian high net worth investor support over the last 5 years, like huge inflows, which have, was somewhat of a surprise, really. They're
And
in
they
our
find
region,
you,
I
do
guess.
they typically find you?
Yeah, well, it's a bit of both. You're always out there marketing, as Sarah would attest. You can't sit still. So, but they have been really supportive of, and like the asset, like something like water, for instance. It's scarce and getting scarcer. If you're worried about climate change, they look at it as a climate change hedge because there'll be less of it in this part of the world. So value should go up. As I said before, uncorrelated deployable market. It's a $31 billion market just in the Southern Murray-Darling Basin, about 60 billion across Australia. So there's scope there, but it's not for everyone. And it will take time. I think funds here will change over time. The North Americans are certainly interested, I think, more now in Australia than I've seen in my working life. That they really are starting to take an interest. I mean, the other thing about Australia is just the very low sovereign risk. That's going to be an issue in many other parts of the world, I reckon, increasingly. So, in addition to the sort of measurement sort of issues and stuff I mentioned before, but I think that they're probably the main things, really. It is evolving reasonably quickly in the scheme of things, I think. If we can get to a position where, say, the TNFD starts generating, moves on from what the issues are to, all right, well, here's a solution and here are some market-based solutions. I think that's where stuff really does transform. If you can have some sort of market where you're valuing biodiversity or nature somehow and you're valuing that loss and building it in and then have to either improve, and I've got some response to that a bit later, but that's been the missing bit really to drive people to chase that extra or the premium you might get just on doing a straight investment. Yep, we can talk about carbon markets. They have helped. They've absolutely helped, but not been without risks and problems. So I think there's real scope there. It's just a process of evolution.
Okay, well, you just mentioned carbon markets. I just want to let's throw together how much do you see looking into the future, or how much can the developments in the carbon market help you, and indeed what's going on in tokenization, which we think is really interesting, particularly in forestry. It's really, really interesting. So how do you see yourselves getting more involved in these kind of these things, tokenizing funds and things like that, and particularly in forestry for you, Sarah? But Cullen just mentioned the carbon credit markets. How might that change what you guys do?
Is that to me or Sarah?
Should we start with Sarah?
Yes, I think so.
Sure, no problem. And just to reinforce what Cullen was saying, I think Kilter Rural in the last question has done a fantastic job of putting themselves on a map of a specialist manager who can do things at scale. So I think it's really important around consistency, transparency, and clarity, just to round out that last point. But tokenization, carbon, they're often, I don't know, interesting words that people have strong reactions to one way or the other. Is this a good thing or a bad thing? I think innovations like tokenization and also this continued development of the carbon markets and the nature credit market, so we can talk about biodiversity credits and that being a nascent sort of movement now, I think they can play a meaningful role in natural capital but they're supporting mechanisms rather than primary drivers of the investment case. So tokenization, it can improve transparency, price discovery. It might contribute to greater liquidity over time, but where we see particular strong interest is around carbon markets. When they're well designed, they can provide additional, sometimes optional revenue stream upside to returns. And it's not about relying on that carbon income to make the economics work. It's really about enhancing project resilience. And carbon markets also play, obviously, a broader role in the climate risk mitigation story. High integrity carbon projects, they manage climate risks much more explicitly. They link that real world mitigation outcomes to financial value. And that optionality with really clear standards and integrity can add to strategic appeal of that. But having said all that, that only works if the underlying assets are sound. Additionality, permanence, integrity, those have to come first. The financial innovation shouldn't follow asset integrity. It should follow the asset integrity, this financial innovation. It shouldn't lead it. So I do get worried when tokenization is put out as the solution without really basically looking at the assets and the integrity of those underlying assets first. And you're right, forestry illustrates that well. Working forests, they deliver climate benefits. They continually remove carbon from the atmosphere. They store it in trees and long-term lived wood products, and also supplying essential materials to the global bioeconomy. So yes, carbon revenues, where appropriate, can complement those fundamentals, but they don't replace them.
And Cullen, you got anything
No,
you'd like to add?
Well, I totally agree with that. It's if you're investing in something and using those reasonably new markets as the key investment principle, I'd be reasonably nervous. They are an addition to what you're doing as best practice anyway. So that's what I was sort of getting to before. If you're managing your assets correctly, you're looking after those biodiversity and water and whatever else it might be in that particular asset cluster, and you're providing a better outcome anyway. You just start to get compensated for that outcome, which is a public benefit. So it's sort of looking like those nature-based outcomes are another form of primary production. That's where I've always wanted to end up. So your base, whatever it is, stock forestry, it's giving you your 5 to 8%. And the better land management and environmental condition outcomes gives you another 1 or 1.5 to 2%. That's the way we've always viewed it. So I totally concur with Sarah's view on that. Again, it just comes back to how do you get agreement on monitoring those the premium. So carbon credits, there's a lot going on around carbon credit plus. So a carbon credit that's based on obviously sequestering carbon and providing that long-term sequestration service, but also then providing a biodiversity benefit outcome and hopefully getting a premium for that benefit. So those sort of two things stacked together fine, I think. And there's good methodologies in Australia anyway, isn't there, Sarah, for that type of activity? Mm-hmm. So that all works. I mean, some of our experiences with carbon markets haven't been that great. So being bleeding edge can be a problem at times. So well, I did it on my own place as well, but in some of our investments, we put between 20 and 30% back to a biodiversity and forestry outcome, only to find the policy of government change, and it all became ineligible for sequestration credits. So there is an element of timing to some of this. Yeah, you want the market to settle down a bit and be able to respond. Mm.
Thanks. So unless, Alex, you've got something to add on to that, I'd like to jump on to the very quickly, the last question I'd like to ask on the TNFD. It was mentioned briefly a little earlier. Has it really made much difference? Alex, do you want to kick that off? The TNFD, is that something you come across when you're doing your due diligence, and how's that affected things?
Well, it's not that we come across... We haven't come across it a great deal. I think generally in terms of standards, reporting frameworks, taxonomies, protocols. People, it can get confusing for a lot of people. It becomes this kind of alphabet soup of, SDGs, TNFDs, TCFDs, etc. And we really have to kind of embrace some of these standards. And I think TNFD has that kind of potential to be really embraced. It's something that people can get familiar with, but they do have to understand it. And in the way, I'm sure New Forests and Kilter Rural have a real deep understanding within their organizations. That's not necessarily going to be an experience that's shared and lived by some of the LPs that are looking at it. So, we're still in a position, I think, where people have to come on this educational journey and do, understanding, by their, subscribe to IFI sustainability and read up on it, get their research and get more comfortable, so that they can then have more engaged conversations with New Forests and Kilter Rural and other natural capital managers.
Okay. And Sarah and Cullen, will the TNFD do the same things the TCFD did for climate, do you think, in the big scheme of things? It took a long time for the TCFD to really bed down, and it's still pretty new. I mean, came in on, you know this better than me, in 2 or 3 stages, and the final one was September, was it 2 years ago or something like that? So you would know better than me, you guys, what difference it's making. I know about Australia, but over here people were talking about it a lot a couple of years ago.
Yeah, I'm happy to kick off with that one. The Task Force on Nature-related Financial Disclosures has been a really constructive development. It's particularly been able to establish a shared language around nature-related risks and dependencies. And I think most importantly, it's helping investors think about nature as financially material rather than just a reporting or sustainability exercise. Alex is right, it's an alphabet soup, and investors aren't quite clear on how to use them all. And we have 2 Japanese shareholders. We often go to Tokyo and have rounds of meetings with Japanese investors. And we had a seminar there in October where one of our investors said clearly to the room of peers, we invest in IP. We have invested with New Forest because of how they are looking at TCFD and TNFD. So often investors will seek out those managers who have been doing work with these types of regulations and disclosures to learn how to integrate that across their portfolios. And so, yes, I do think it's really helpful. It's been good to emphasize location-specific risk because it aligns closely with how natural capital assets actually behave on the ground. And it's moving away from high-level abstractions and really engaging with drivers of risk, drivers of value. It's still in its early adoption curve. So I think the ultimate impact will be how effectively these disclosures are really integrated into investment decision-making, capital allocation. We're seeing that happen now. We're seeing more and more conversations around that. And it's about the examples, really. How does water availability that Cullen is looking at, heat stress, fire risk, soil conditions, how do those differ asset by asset rather than relying on country level averages? So, for example, this is how TNFD is really getting into the heart of natural capital from a financial perspective.
Okay. Cullen, to you, but very quickly, we're nearly at the top of the hour. I want to make sure you guys are off at, what is it going to be, 10 o'clock your time in a couple of minutes. So quickly, anything you want to say on TFD? And I've also
look, I think
go ahead. Go on.
I think it has been, really important in, I guess, identifying those externalities that were not costed, by business operations. So nature was paying the price. The feedback loop there is if nature's no good, then the rest of us are no good. I think that's been a really important discussion. And it's stimulated a lot of activity here. When you're turning up to workshops run by the big 4 accounting firms, somebody thinks there's going to be money involved here at some point. So I think it will evolve over time. It's been a really important discussion. It has been overwhelming, I think, for some corporates. Actually identifying the problems been really good, but actually identifying solutions now is the next big step that, that's going to take a fair bit of effort, but I think will evolve over time. Whether it ends up in this form or it's something new, it's been a really important step, in progressing it.
Great. Very last, if you can do a sort of 30-second answer to this, What do you see is on the big thing might happen on the horizon in natural capital over the next year or two? Something we can have a sort of hanging quote with on what you've said. What do you see looking at your crystal ball that's going to happen? Anything it's the same as usual, or anything particularly interesting out there? Anybody like to say something on that?
I think
Well,
there's a
I'd
huge swell in
say
interest in this
go,
asset
Sarah.
class. Sorry. I think it's really encouraging that the conversation has shifted from why natural capital matters to how it fits into portfolios.
Right.
Yeah, I agree. The only other thing I'd add is, what's going to stimulate the change and quick change. And I think the impacts of climate change and events, people respond to events. I think that will start to really generate some movement as we increasingly, find parts of the coastline wash away or, cities get flooded or what have you. That's really going to start pushing people. So I do expect it to jump ahead really quickly. Whether I'm around to see to the end of it, I doubt it, but there'll be lots of scope.
Alex, you got something you want to contribute on
Look,
that?
and with my due diligence hat on, I think we'd really love to see more scientific measurements of outcomes and interests and alignments with those, whether they be fee alignments that are based on achievement of those important goals that are set, and also that those gains can be shared with investors.
Brilliant. Thank you very much indeed. Really much appreciated you giving up your morning on what is it, Wednesday where you are? So Wednesday, the middle of next week in Australia, isn't it? Yeah, with the time difference. So thank you very much. I'm just going to stop.